Great. Hi, everyone. It's been a long time since LGCA has had a webinar, but LGCA as one of AGRC's training partners has decided to, kickstart things on that front. And this is our first one with two very esteemed guests who will be discussing the FCA's proposed changes to the safeguarding regime for payments and e-money firms. Before we jump into our discussion, we have 9 questions here for you today. I'll get some admin issues out of the way. We are recording this webinar, so the webinar will be available as a video recording, hopefully within the next couple of weeks. And also we will have a transcript that will be shared with everyone who attended. This will be shared also with Allison and Daniel for their network and crowd, etc. So, also, if you have any questions for our speakers, make sure you drop those questions in the chat or the Q&A. I will try to work those questions into the discussion, or we'll save them for the last, 15 minutes or so of the panel discussion to cover some of those topics that you might have a greater interest in. With that out of the way, I would like to ask both Allison and Daniel to introduce themselves. Tell us a little bit about who they are and what is their particular interest in safeguarding, and we'll take it from there. Allison?
Thanks, Matteo, and thank you very much for the invitation to speak. I am Alison Donnelly. I'm a payments regulation specialist and director of the Governance, Risk and Compliance Consultancy, FSCOM. Over the past 10, 11, 12 years of FSCOM's existence, we've helped firms understand safeguarding requirements. And prior to that, I was the e-money policy specialist at the FCA. So I've seen safeguarding, the FCA's approach, and how firms have understood the guidance from both sides. And so I've worked on a number of papers and thought leadership items, and I'm really keen that the safeguarding rules are fit for purpose going forward.
Excellent. Thank you, Alison. Daniel?
Yeah, hi everyone. Matteo, thank you very much for having me. I'm Daniel Saliba. I'm a financial crime and regulatory expert. I've been in the industry for almost 20 years now, working as chief compliance officer, working with startups and large corporate organizations. And I also had the privilege of working with FSCOM team. And over time, I really kind of witnessed a lot of practices in safeguarding that really it's interpreted in a very wrong way sometimes, and there are some practices that are also great. There are some automation that a lot of initiatives that firms comes up which are also great, and this consultation is particularly important for me because I am speaking to a lot of people, including my clients. Not many firms seem to understand the impact or the long-term impact of these changes. The regulations are really necessarily important, but in some cases it's misunderstood, and we need more and more firms to respond to this consultation in order to make sure that we have this dialogue with the regulators to ensure the changes are positive for everyone.
Excellent. Thank you, Daniel, and thank you, Allison. So to set the stage, let's start off by looking at what are the intended changes. And I have 2 questions, and Allison can get us started out with this one. But, why does the FCA intend to make the changes to the current regime? And basically, what outcome is the FCA seeking, Allison?
Thank you. So safeguarding has been around since the payment services regime first came in 2009. So we've had over a decade of practice and implementation of safeguarding rules as they stand. But I think this is probably the subject area that has been most problematical for the FCA and in turn for firms since throughout the lifetime of the regime. Clearly, the UK government and the FCA are very alert to consumer and reputational damage of a firm failure. And over the last number of years, we've seen a few firms fail. And so we have seen that customers haven't been able to get all of their funds back, and it's taken a long time. And actually, in picking apart those arrangements of those particular firms that failed, there's been a whole raft of gaps and lackings that have caused either funds not to be where they should be, or so mismanagement perhaps, but also the fact that it's so complicated that it's taken a very long time for the insolvency practitioners to get the funds back into the hands of the people to whom they belong, which has naturally eroded the funds that are left to be distributed, because the insolvency practitioners' costs come from that asset pool. And so what we have is really, and I think widely recognised, imperfect rule set around safeguarding the funds. So this is about protecting customers and creating trust in the non-bank sector. The non-bank sector over the last decade or so has really grown. The amount of funds being held by payment and e-money institutions, the amount of customers using payment and e-money institutions has really, really increased, as indeed has the sector itself in terms of the number of firms in the regime. And so what it brings to is just an increased risk to customers. So again, it's about trust. It's also about the question of whether this regime is fit for purpose. It's a very small amount of words and rules. If you look at the legislation, it really amounts to just a couple of hundred words, and that is meant to determine how these funds are protected. Over the years, the FCA has produced guidance to go alongside those rules, and the guidance itself has increased 2 or 3 times, but still firms are not really understanding or not really implementing the rules as they are and the guidance as it is. And then I think there's just a fundamental difficulty with protecting funds, because the whole point of protecting funds, or the best way to protect funds, is to keep them safe in one space, static. But payments is a dynamic business. Funds are meant to move, and so there just is that mismatch in how we protect customers' funds and how we make sure that they're safe, but also make the money move and get customers what they want, which is easy, frictionless payments, whether it's in country or beyond borders.
Thank you, Alison. Daniel, anything to add there? Or?
I think absolutely, as Alison mentioned, it's it's a very much needed step and very welcome step from the regulators to enhance the safeguarding of customer funds. One of the things that I feel it's also necessary that as an industry, and I'm an advocate for the industry here, is to demand more clarity from the regulators on these regulations. So this consultation is truly our opportunity to ask, okay, well, in the past, you've given us these 200 words that are supposed to safeguard customer funds. Can you elaborate? This is our golden opportunity to get to that level of understanding of what truly the regulators expect when it comes to these processes.
It's such an important point, because this is really the opportunity to grapple with those difficult circumstances and situations, and the complexity and range of business models out there means that it's difficult for the regulator as policy drafters to really understand how these rules are implemented in practice. And so, as Daniel says, and we would absolutely join you, Daniel, in urging firms to put your questions to the FCA. It is this golden opportunity. There's been guidance before, consultation on guidance before, but this is the golden opportunity to get the rules right. What I think will be difficult is to get the rules perfect, to get them suiting every firm, to get them priced at the right point, the proportionate in the cost. But this is the opportunity to do it. And what is the FCA's outcome? What are they seeking? Definitely clarity and certainty on the rules. They've stated that. I think they're also looking for greater ability to supervise firms, to really get under the hood of what's going on, and which will lead to enforcement. I think what's really interesting about safeguarding is there's only ever, as far as I can see, been 2 censures on payment or e-money institutions over the course of the last decade or so. And both of those happened when the firm had already gone bust. So there was no real there was no way of getting customers' funds back or any kind of compensation. I think there may also be another agenda here in play, which is about, to the point about costs for firms, is about perhaps reducing the number of payment and e-money institutions in the sector.
Perfect, excellent. I know we've touched upon some of these items already, but let's look at it more from a practical perspective now. Essentially, let's look at the schedule. I mean, how is the FCA planning to introduce these changes? And this is for Daniel. And also, what are some of the key proposed changes as per the FCA?
Yeah, so the FCA is planning to introduce these changes through a phased approach. So we will have the proposal is to have 3 phases. Phase 1, 2024, which I feel is very optimistic because we're already coming to the end of the year, and the consultation date is December. So really the plan to introduce robust rules around the requirement on how firms will hold the customer's fund and the protection. The plan also in phase 1 for firms that potentially the firms will need to provide more detailed reports to the regulators on their safeguarding practices. For phase 2, which comes in 2025, 2025 to 2026, this will be a more rigorous audit controls. So there is in the consultation there are additional requirements around the audit of safeguarding practices on firms, and more specific requirements about the type of audit and auditors who will be able to conduct such audits on firms. The phase 3, which comes into 2026, this will be kind of like the aim of that is to introduce even more comprehensive safeguarding measures, such as higher level of capital or liquidity buffers to safeguard customer funds against market volatility, etc. The FCA also plans to introduce in its third phase new reporting obligations. So we will look into that in a little bit more details. And there is also potential for these reports for transparency, where firms will be required not only to submit their audit findings to the regulators, but potentially there is implied that firms may have to share these details with their customers to provide them with assurance that their funds are safeguarded properly.
Thank you, Daniel. Alison, anything to add there?
I think it's an interesting approach, having this interim rules and then the end state rules. It's really about making sure that the changes that need to be made, which goes back to the fact that the rules are in legislation, they're in as they currently stand, they're in Treasury regulations, and so they need to be able to move them out of that and put them into the FCA's handbook, and so the phased approach is a tool to get there.
Perfect. Switching gears a little bit, or at least introducing a new subject here, is let's look at CAS, at the Client Assets Source Book. And Alison, do you want to just give us a brief overview of CAS and its applicability here?
Yeah, certainly. So CAS may not be familiar to payment and e-money institutions who have not had to comply with it previously. And that's to the point that the legislation for payment and e-money institution is in Treasury regulations. And that goes back to many, many years ago when the directives were written and had to be implemented in the UK. The Treasury looked to the FSA as it was then, said, do you want to put this into your handbook, which is where the FSA had previously put all rules, but because it was maximum harmonisation directives, the thought was, well, if we put them into the handbook, there'll be so much of the handbook that we have to switch off, it'll be a right old nuisance. So let's put it in Treasury regulations. it kind of set up the regime so that payment and e-money institutions were just treated differently. And that has an impact on how the FSA at the time looked at payment and e-money institutions, how familiar the supervisors, the teams were with this sort of separate standalone kind of regime. But anyway, that's history. We're looking to the future, and what we can see is that the FCA's had a change of heart. Let's bring these guys into the payment and e-money institution, into the sort of FSMA handbook style regulation. So what has to happen is we have to switch off the Treasury rules and switch on elements of the handbook. And that could only happen with Brexit. So there we go. There's if you can regard that as a positive, that's a positive of Brexit. So we now have the ability to get rid of the Treasury regulations, specifically, first of all, only for the safeguarding regime down the line. It'll perhaps be for the rest of the regime, but it'll come into CAS. And so we have a brand new chapter for in the CAS rulebook, CAS 15. This will be for payment and e-money institutions specifically, and will include the rules. It's a lovely place for the FCA because they're very comfortable with CAS. They understand it. They've built it. It's very detailed. It's exactly the way they want it. That's why it's easier for them. They're more comfortable bringing the rules into their own territory. The interesting thing to me is that it's taken so long for this consultation. This consultation has been promised for years now. We know that they'd been working on it. We know that they'd hoped to publish it towards the end of last year, much earlier in this year, but it's taken a long while. And perhaps some of that is to do, no doubt, that will be to do with the complexity of the payments model, because again, CAS's audience as it stands is a very different type of financial services sector to payments. One's much slower paced, money doesn't move quite as much. Payments, the whole point is fast moving money. So fitting the CAS rules to the very specifics of the payment service model, including the likes of the insurance method, which there's no concept of insurance under the CAS rules as it stands, will now have to be brought in again in a separate chapter specifically for payment and e-money institutions.
Thank you. Daniel?
Yeah, I think Alison covered it really well there, and it's regardless. It's not a new thing for payment firms by any means, but it's really regardless to where the safeguarding rules are going to sit. It's just the kind of like the potential of making sure that we have that clarity on what they are, whether they sit in CAS, whether they sit in separate section in the FCA's handbook. It doesn't matter. We kind of like it's just important that we are working on these rules and understand these rules. There's, again, to reiterate from what I said earlier, there is that clarity from the FCA on their expectations when it comes to safeguarding. So that clarity is extremely important.
Thank you, Daniel. We have a question that just came in, and I think it's related to the next question we have. Let me read out the next question we have. But basically, let's look at more specifically how CAS relates to payment and e-money firms, specifically when it comes to payment service providers complying with CAS 7. And the question we have from the audience is, would it be correct to follow the CAS rules to prepare for the new safeguarding rules into play? Daniel?
I would say there is no harm of familiarizing ourselves with the CAS rules. There's a lot of things that. So let's look at safeguarding. Let's forget about all of the rules for 1 second and look at the safeguarding requirements. The essence of safeguarding requirements is to ensure that customers' fund is safeguarded properly and the practices around it are solid, of solid standard. So wherever we get the information from, whether we need to start looking at CAS or other practices in different jurisdictions, as long as we have the right processes and controls in place to ensure the safeguarding of the customer's fund, that is the key thing. So by all means, let's learn more from CAS, from the firms that CAS applied to over time, from what they've done right, what they've done wrong. Let's learn from any rule books and make sure that we have the right processes internally.
In terms of preparation, Daniel's absolutely right. the rules are there in CAS 15. They're published with a consultation paper. So you can see what those are. You can begin preparing for them now. What you don't know is whether the rules as they have been published in CP 2420 will be the ones that will come into effect, either for the interim or the end state rules. It is a consultation. So there is. Let's hope, the FCA is open to hearing what thoughts are. And so there is a possibility that things will change. As we know, of course, once a regulator, an authority has put out what they think they want to do, it will be difficult for them to shift their minds. So the scope for the consultation responses and how those rules might vary from what we have at the moment, that's obviously up for debate, but you see the emphasis here in what's published in the consultation, and really the vast body of material that has been built up, the vast understanding of how those rules apply, that firms that are already subject to CAS will be very familiar with. That's the learning, that's the indication, that's the thought processes of the FCA, and that's exactly what you should bring to bear on how you interpret and understand the CAS 15 as it will come into play. But again, it's consultation. So now is the time. If something's not clear in there for you as a firm, that now is the time to get the FCA to explain what they think it means, what they want it to mean in terms of your particular business model.
And just if I may add there, actually, it's important that we learn more about the CAS rules for firms who are not already familiar with the full CAS rules as well. The reason being because if the FCA is starting to apply CAS rules to the to e-money issuers and so on, the full rules, in this case, we need to be prepared for the next questions that are going to be, or the next proposal from the FCA and what that looks like. So understanding that is fundamental to make sure that we position our response to the FCA correctly.
Thank you, Daniel. So now moving on for Alison, how does the FCA expect firms to use the statutory trust structure?
Okay, so the statutory trust comes in as part of the end state rules, and I think it's fair to say that the interim rules are mainly what the FCA has already put in place through expectations in the approach documents. They're just going to be codified in actual rules. Now, there's some things that are different, like the resolution packs and the like, and they will come with costs. And as Daniel mentioned, the move to having a statutory audit and not a firm undertaking the audit, that will incur extra costs. But mainly they are very, for firms that have been doing safeguarding as close to what the FCA has expected as possible, that should not be a huge uplift. The end state rules will be a little bit more different. That being said, the point about the statutory trust, there's not too much for firms to do. When the FSA brought safeguarding rules in, they had thought it created a statutory trust anyway, and so it was a legal case against one of the insolvency the firms that went insolvent that created a judgment where it was said that there isn't a statutory trust created. The FCA is very committed to statutory trust being created for the safeguarded funds, and so the rules are just making that happen and come into play. So not much by way of material change for those who only segregate safeguard by segregation, which is where you move the funds into a deposit account, because that deposit account will then be regarded as a statutory trust. Your banking provider will have to confirm that in the acknowledgement letter. So there'll be a sort of admin task of acknowledgement, repapering on acknowledgement letters. There will be a bit of a difference for those firms that safeguard through the secure low risk liquid assets, because to do with statutory trust in a very complicated way that I'll not be able to explain very clearly, they may need to get further authorization under PISMA in to cover the investing the funds. And so if you are a firm that uses that method, pay careful attention to whether this is going to mean that you have to apply for a further authorization, which will likely cause a little bit more complexity in your processes.
Thank you. Daniel, anything to add?
Yeah, I totally agree with Alison there. The only key thing as well, just to highlight and remind everyone, is that there will be requirements similar to what we've seen in the past from the FCA, where it's a CEO letter highlighted the requirement to write to customers and explain to them the way they safeguard funds. It's going to be an additional requirement to make sure that if you are using statutory trust structure, then this need to be very transparent and communicated to the customers as well.
Thank you. We have a question that just rolled in about statutory trust. I guess since we're talking about that, I thought it'd be a good idea to tackle that right now. The question is, the concept of statutory trust in pensions, etc., require a separate legal entity. Can we assume that this will mean EMIs creating separate legal entities for the client money? Alison, Daniel?
I'm not sure that it does require there to be a separate legal entity, but I will certainly take that away.
I'm not aware of that either, so it's something for us to take away and respond later.
Okay, perfect. So whoever submitted a question, you feel free to get in touch with Alison or Daniel after the webinar, and you guys can look into that. Okay, moving on. For Daniel, what are the proposed changes to the audit requirements?
Yeah, so the audit requirements, it's going to be a mandatory audit, annual audit. The key proposal here is that payments and e-money firms will be required to conduct this annual audit on their safeguarding arrangements. There need to be evidence provided to support that they are protecting their customers' funds correctly. And it will need to be in line with the regulatory requirements set out in CAS, of course. There will be a broader scope of audit as well. So there will be for firms need to comply with maintaining proper reconciliation practices. Now, this historically it's always been the case, but there will be more broader requirement around that. So for firms need to keep the reconciliation process. There are some nuances in the new regulations, where the proposed regulations where it might affect the way reconciliation are conducted. There was more freedom up until now in terms of the periods and so on, I would say freedom, but actually I'll correct that. It's more ambiguity on the frequency of reconciliation. So we should expect a little bit more definition of what that looks like and the FCA's expectations around that. We talked also about the reporting. So reporting to the FCA, the only audit report is going to be need to be submitted to the FCA. Now, on this one, I really would like to see also from the FCA and understand is that, so we historically, we always submitted various reports to the FCA, but as many of us here know, it's seldom that we hear back the feedback from the FCA. So really, this is our opportunity as well to ask the FCA, by all means, we would like to submit to you our audit reports, but we would like that feedback as well. We all know that the FCA and various other organizations are, it can be under-resourced, just like any firm. So it's understandable. But if we are really aiming to provide assurance to customers that their funds are safeguarded, then the work needs to be not only from firms and having the audit, but actually some feedback on these practices. I've seen it a lot in the past with startups where we start the application for licensing, whether it's EMI or otherwise, we submit the application, you provide the processes around safeguarding. But as we know, these firms, the product with these firms will always change, will evolve over time. Their safeguarding processes need to evolve and change with the product as well.
Mhm.
We haven't seen in the past any response from the FCA when a new processes changed or added to existing customers' firm. If the firm submit those processes to the FCA, we have not seen a response or feedback. So this is really key thing for us to the industry. So we're not waiting until something goes wrong and then the FCA comes in at that point. We want that proactive approach from the FCA as well. There is also, I mentioned earlier that there could potentially be a requirement for the audit findings, probably not the sensitive area of the findings, to be submitted to be provided to customers. So that is another thing we need to be very careful with how we respond to that question from the consultation, just to make sure that sensitive information are not leaked to third parties in regard to the processes. The In terms of the auditors themselves, we talked that there will be statutory auditors as well. So this is going to be really interesting one because that means not any audit firm that carry out safeguarding audits today will be able to offer that service. It needs to be statutory auditors that will provide that service, and that is fine. However, is this going to create additional costs to firms? I had the kind of like there's been some quotes which are astonishing, 200, 300,000 per for audit per year. So imagine if you are a startup, this is going to take a big portion of the startup's fund that they will not be able to afford. So what does that look like? What is the impact on these startups and all firms in reality? This is going to be a really important aspect of the consultation as well. Consequences of failure. So there will be bigger fines and stricter enforcement actions taken on firms that fail those audits. So that is the other thing. And of course, as I mentioned, the cost to firms. This is something we need to tackle very carefully and sensitively, both with statutory auditors and with the regulators.
Thank you,
I think
Daniel.
the
Alison, anything? Yep.
yeah, I think the cost is a really important point, as I flagged earlier. I think the sector is big, and a lot of firms join the sector, have been joining the sector each year, up until probably around 2020, when you'll have noticed that the authorization numbers dropped significantly, and that signals a new approach, or a new approach back then from the FCA, and that's about making sure that those who are entering the market regard it as a privilege. It's an opportunity to work in this space, but it comes with a cost, and the cost of doing business will now have to include the cost of doing an audit. The audits, FSCOM does an awful lot of work in Ireland as well as the UK, and Central Bank last year required their payment and e-money institution sector to get statutory audit firms to conduct audits on the safeguarding arrangements. And we saw there, it was certainly a hefty price that came with the costs. And also there was a point about, actually there's a bit of a crunch because they all had to get the audits done at a certain point in time. And there's only so many firms with a probably much smaller number of people who are skilled in payments sector and understanding the business models, understanding how safeguarding arrangements apply in the payment sector. So there will be a real crunch, and costs will definitely be much higher for those firms. And the audit is in itself a very important thing. We have really seen how the sector's approach to safeguarding has been lifted up since 2020, when the FCA required firms, authorised e-money institutions and those payment institutions that are subject to statutory audit because they can't avail of the small companies exemption. We saw how those firms who undertook audits in the first year, the audits were full of high impact findings. By the second year, the third year, those high impact findings reduced. So we can see how auditing and the having to take seriously the responsibility to submit those safeguarding reports to the FCA really focuses minds at board level and therefore throughout the business. So I think there's a lot of value in that. And there's a lot of value in standardizing the audit process. I think there's a range of audit providers currently operating, some of whom may not be as skilled and deeply knowledgeable, and some of whom may be doing a very light touch scope compared to others. So it's important to standardize that. But yes, we must recognise that there will be a greater cost to that, which will impact the number of firms in the sector.
Thank you, Alison. We have a question that just came in a few minutes ago, but I'll throw this out there before we have our last concluding sort of question. But in their proposed, here's the question. In their proposed monthly regulatory report on safeguarding, the FCA mentioned the frequency of internal and external reconciliations. What do they mean by external reconciliations versus internal? I'll throw that out there for one of you to tackle, or both of you.
This is a super tricky piece in the industry. An internal reconciliation is where you use internal records of how much funds you expect to be in your account and how much funds are in the account. That has to be internal records. The external reconciliation is where you compare that with, for instance, the bank statement that shows the funds coming in and out of the accounts. Most firms that we've audited have the external reconciliation nailed. What they don't have is the internal reconciliation. In some cases, they could do an internal reconciliation because there are internal records, but oftentimes, actually, there isn't an internal record that they could use for that. Now, whether that's a case of they needed to build that themselves, or actually there is just no way of collating that data. And if we look at the difference again between the sectors here, so where you are going to be doing something in a different sector. So for instance, if you were purchasing an FX deal, you communicate with the firm first. They therefore have a record that there should be funds arriving in their account, and so that creates an internal record. In a lot of e-money institutions, for example, firms, it's not nobody communicates to the firm first that they're going to buy e-money. They just put money into their account, much the same as I don't tell my bank account that I'm going to get paid on such and such a day, and this is how much I'm going to get. The money just arrives in my account, and so to generate an internal record of that, it is tricky, and so this is a really important point for firms to consider internally as to how they'll achieve the internal reconciliation. It's a requirement now, so they should be doing it. So work out how they can achieve it. If they can't achieve it, they need to put that case to the FCA and see what the response is.
Mm-hmm. Thank you, Alison. We just had another question come in. So before we go to our last, go ahead, Daniel.
But I just wanted to check in terms of the reconciliation, this is a really, really important one as well. And Alison and myself worked on an issue here, which I think it's really important for all firms to push for clarity on the reconciliation part when it comes to the new changes. This is an old issue that we've experienced before, and I am going to suspect that this is going to continue unless we demand this clarity from the FCA. It's really very much one to do with transactions, so card payments in particular, where you have authorized transactions and settlement transactions. There is ambiguity when it comes to the reconciliation for the safeguarding purposes in terms of at what stage are we going to safeguard? Are we safeguarding on the basis of authorized transaction, or are we safeguarding only until the settlement transactions come through? The difference this makes is that if we are safeguarding customer funds until the authorization only, which I'm strong advocate for that, because I think if the customer walked out of the shop with their goods, then that the money that we hold for them in the safeguarding account that are relevant to this to the value of the goods that they purchased. In this case, that's it. It's no longer their money. It's our actually money that we owe to the scheme. So from this respect, I would say we should retain kind of like we should stop safeguarding that amount at the time of authorization. Now, the ambiguity here is that there is no clarity on whether we should, that this is a acceptable um, practice, or whether we should hold the money until the settlement comes from the scheme. That makes a huge difference to companies, and it's not an issue that often raised, but it is actually an issue, and further clarity on this is really needed when it comes to reconciliation. There's also, when it comes to reconciliation, whether it's card transactions or various companies who rely on transaction files or files coming from third parties, such as the scheme. The time difference. So if we are going to do internal reconciliation, but we don't have the external reconciliation already, the file relevant to the external reconciliation, then in this case we will never have a proper reconciliation here between our internal record and external record will never match. So how is the FCA planning to help firms deal with this? What does that look like?
It's a really good point, Daniel, and thank you for raising it. It does make me laugh that the FCA has very confidently asserted in the consultation paper that they've absolutely provided clarity on when safeguarding begins, when it ends. But what they've done appears to be to just repeat what they'd said previously, which doesn't give the clarity on these cases that are very specific to business models. Now, unfortunately, I think once we get the clarity, we're not going to like the clarity, because I think the FCA is going to go for the super duper requirement, which will be to safeguard. So the card issuer will be safeguarding, the merchant acquirer will be safeguarding, everybody will be safeguarding the same value, and that would be very expensive to the sector. So we do need to be careful, because you always have to be careful what you ask for, right?
Yeah, I totally agree with you, Alison. But equal at the same time, especially from auditing perspective, right? So if an auditor is providing a firm with their opinion at the moment, every firm is doing different thing to the other when it comes to this type of
Yes.
reconciliation. So how are auditors going to conclude that a firm is compliant if we don't have that guidance from the FCA, if we don't have that clarity from the FCA? I always talk about these practical aspects because they are issues that I had to deal with over my time working with various firms. So, and I know how painful it can be for firms trying to figure out, we want to do the right thing, but what is it?
Absolutely.
Right. Excellent. We have another question I mentioned that rolled in, and here it is. At the moment, EMIs are able to earn interest on funds held with a safeguarding letter. How would this differ with the move to a statutory trust? And also, how would the requirement to settle interest to the trust account and for the benefit of the end beneficiary contradictory to EMI rules not paying interest on issued e-money? It's a strange question there, but maybe if you read it, you might pick up its nuance. It's in the chat. Mm-hmm.
Yeah,
go ahead,
thank you.
Alison.
I think this is a question about whether, as it stands, you can put funds into a deposit account. That's if you're safeguarding by the segregation method, earn interest on it. Payment and e-money institutions can then keep that interest because they don't have an obligation to pass it on to the customers. I think e-money institutions are indeed not even allowed to pass interest on to their customers, because you're not allowed to incentivize customers to hold funds on account as e-money. Because the purpose of e-money is to make payments and not as a savings vehicle. I don't think there is any difference with it being a statutory trust on the basis that the FCA always thought a statutory trust was being created under the old regulations. It's just that the judge said you got that wrong. So I think the same situation would continue in this process, in the new rules, as long as the interest is not paid into the safeguarding account. The difficulty being that if you pay it into safeguarding account, it's funds that belong to the firm and not funds that belong to the customer, and therefore should not be commingled in the safeguarding account. But again, it's a really important point. One of those sort of cases that arise that we must make sure are covered in the consultation, and so it's important for firms to put that in as a question to the FCA.
Excellent. So we have one last question here. There's a comment here. The difference here is under CAS, and there can be an obligation to pay out a portion to the trustees.
Is that a
any comment?
comment?
Yeah, it's just a comment. So at the bottom of the chat.
Okay.
As you were replying, yeah.
Yeah. Granted, it's an like I said, it's an important point for us to bottom out and through the consultation.
Perfect. So we have one final question to just kind of summarize what we have been discussing, and Alison can get us started with this one. But essentially, I mean, to talking to the firms who are here with us and you know, who are going to listen to this webinar and who are going to be involved in this consultation, I guess, or want to participate in it. You know, what should firms consider as part of their response to the consultation? Do you want to give us like a laundry list of things that they should consider, Alison, just as some tips of sorts?
Well, the great thing is, first of all, we've covered a few already, which I'll go through. But the second point is, there is the more and more we have of these discussions, the more issues that arise, and it's very easy to just sort of read the paper and sort of answer directly the questions. You've got to think how this actually applies in your firm, and that's when the real issues will come to fore. So, you know, urging all heads of finance, safeguarding policy owners to think these things through now before the consultation deadline. So some of the things that we've already mentioned, the definitions of when safeguarding requirement starts, and more particularly when the obligation ends, in all the various use cases. So Daniel raised the important one about when card money, e-money is spent, can the obligation end then, or must it not end until the funds go to the merchant acquirer? The point around the reporting, there's a point around reporting. Every month, firms are to report the safeguarding values and any breaches that have happened during that period. Does that mean that you don't need to report mid-month if something happens, because you could just wait until the end of the month and report then, or is that a duplication, so you need to make sure it's covered in both, which is not necessarily overly complex, but definitely one you want to get right. And then there's complexity around the audits. We don't as yet know what the standards will look like. That's to be constructed, so that's a gap in knowledge before confirmation there. Firms have got to consider whether the phased approach will cause greater difficulties. And I think that's an important point, particularly in reflection of the audits, because an audit, it covers an annual period. Potentially, we could have an audit period covering the rules as they stand now, maybe by just a few days or a month. Possible that it will definitely cover the interim state. Might it also cover the end state? We have no clear deadlines as to when the end state rules will come into play. I don't think the FCA can even determine that at this stage, because there's some dependencies on other consultations, which may mean that it's pushed out a good few years and so not relevant. But nonetheless, an audit period could cover both the rules as it is now and then the interim state, which creates complexity for the audit process.
Perfect. Daniel, anything to add there? Or?
Yeah, I think it's really important for businesses, particularly those with complex products, arrangements, and structure, to highlight what it looks like, what the changes are going to look like for them, and what the impact it will have on them. Particularly, I think we've mentioned recently, we were discussing at the Payments Innovation Forum, where we discussed agent model and how the issuers who have agent models will effectively have to put money out of their own pocket to safeguard funds held by their agents' customers. So that is going to be an impact that is really important for these firms to look into. The phased approach, complexity around that, as well as Alison mentioned, is something that we need to understand. We need a little bit more clarity on it. What are these phases going to look like exactly, rather than, when we look at the consultation today, it's very much what the propose. Okay, it's going to be stronger, or more tighter rules in phase one, and more kind of like strict, more regulations and coming up in phase two. And then we're going to get to the ultimate phase three, where it's going to be very clear to everyone and so on. But what does that look like, right? We have not seen the details around that. What areas are going to be highlighted? At the moment, to me, the consultation is very, very high level. So we need a little bit more clarity and definition around the particular areas related to different business models in the industry. Is a trust model appropriate for every firm? That's another thing that we need to take into consideration. Or is cash style regime appropriate for the firm? Those are really important things. And finally, last but not least, is the cost that is going to impact all the firms, from startup to large organizations. So that is something we really need to voice to the regulators, because we need to work with them on the phased approach. We need to make sure that it's realistic. It's not going to disrupt the industry and firms' operations. And we need to work with them on further clarity. So those are the things from my side.
Excellent. I think we have reached the close of our webinar. I want to thank both Alison and Daniel for sharing their insight with us and all of the knowledge and expertise on the subject. I'm sure anyone who wants to reach out to either Alison or Daniel on LinkedIn, they'd be happy to engage with you and answer any questions, etc. you might have. We will be emailing also everyone who attended and who registered with some information, including Alison and Daniel's contact details, etc. With that said, let me get some admin issues out of the way before we say goodbye. We have recorded this webinar. The recording should be available within the next couple of days, hopefully, and we will share that on social media and share that with all of the attendees, also with both Alison and Daniel for them to share. And we'll also have a transcript, but that should take us a bit longer. We'll also, develop some articles summarizing what has happened here with the transcript, etc. If you have any questions, again, as I mentioned, just send them to us and we can forward those to Alison and Daniel, or just engage with them directly on LinkedIn or via email. So with that said, on behalf of LGCA, just wanted to thank Alison and Daniel once again, and looking forward to the next one.
Thank you very much, Matteo. Thank you, Daniel.
Thank you,
Thank you,
Matteo.
everyone.
Thank you, everyone. And Alison, thank you very much for